Good evening. My name is Daniel Young. I'm the owner and founder of Adaptive Perspective and the Adaptive Perspective social media platforms. This video is about using our closed-end fund investment strategy system. If you want the full methodology on how we are combating this market space, but also how we're preparing for our future, then head over to Facebook and check out my group there called Navigate Your Finances, where I talk about our 12 steps to financial freedom and outline the whole structure free. Um, so reminders, this is an unedited video. Who knows what you'll hear in the background as I film these in my house. I am not a financial advisor. I am a financial strategist, and I don't speak like the herd. I walk in limited company. Sometimes I walk alone, and I'm okay with that. So where are we? Where do things stand? The talk show guys continue to talk about ETFs for bonds and AI. But that's not me. I mean, one, I think their advice is redundant. I find they steer you away from where you ought to be, and they play into hype. Like, do you notice that the same people tour all the talk shows, but in one week they're an expert on this, and the next week they're an expert on that, and the next week they're an expert on something else, and their advice just isn't that great. And their advice is not me. So I'm here to talk about closed-end funds and not anything else. So on my weekly emails from the people, I mean, I subscribe to maybe three or four free newsletters. I pay for one of them. Only thing I pay for is the Contrarian Outlook membership. But of my weekend reading, which I did today, the only thing notable in all of the stuff is that Brett Owens, the key contributor to the Contrarian Outlook, is back on his bond bull push. And what I'm going to tell you, he's said plenty of times before. It's not like I'm stealing his data. Uh, biggest thing that I'll say is it's his data. Brett Owens uh, dishes really good financial advice, and he is back pushing bonds based on the current market space and the potential of the future market space. And I'll get into that. Um, but that's good advice for us. So, in addition to bonds, where should we go? Senior loans, real estate, data management, energy, pretty much the same stuff I've been talking about. But the bigger question is any of that still in record discount land? I mean, there's a system at play. So is any of that still fitting the system? And the answer is yes and no. So with the Fed still teasing a rate reduction sometime this year, maybe one, maybe three, maybe. Seems the earliest one would be June, which would be fitting because it's right at summertime. But at the same, there's not a huge difference between a 0.25% loan and a like if you go six and a quarter and six, there's not a huge rate difference. There's not a huge monetary amount, but the emotional and the psychological game at play and how the Fed's overall rate impacts all the other rates, that's interesting. So let's see. Where am I? I'm off track. It's a good thing of having notes, but at the same time, I got to find out where I left off and where I deviated. So, with the Fed still teasing rates, we're in the breath before the plunge, or we're in the we're in the stage. So, where would we be best to look at? Like, what would draw our attention most? What holds the best promise for the future? So if you think of what's needed for the future and what would do best for a rate gain, you can play this one of two ways, right? There's at least two sides to a coin. There's really three, right? The two faces and the edge. Um, you can you can look for the future and plan your portfolio to weather or do your best to attempt to plan your portfolio to weather any market space. You can buy and sell in the short run, and then you can kind of do both. You can build parts of your portfolio to weather any storm. You can buy bonds low, you can buy energy low, right? And then you can kind of swing your investments, which is another Brett Owens term, but you can get into something and set a profit margin and then take your profits and then swing that forward into another one, all the while taking dividends from everything. So it really does come down to you. But of where we are in the current market space and of where the market is headed, what would do best long term? I think we look at real estate and bonds. I think we look at senior loans or fluctuating rate loans. I think we look at oil because whether you like oil or not, even solar panels are made out of oil. Windmill technology is made as a derivative of oil, right? All of these things stem from oil, as do parts of your shoes, parts of the furniture behind me, parts of your refrigerator, your cell phone, your laptop, the microchips and everything. All of those are oil, or are oil byproducts and derivatives. So to completely cut oil out is not a great idea. We look at the overall energy infrastructure of things. You look at oil, liquid natural gas, the transfer of one energy to the other, utilities, all the stuff. Uh, so where should you invest? Really, it comes down to you. I know our strategy. Do you know yours? Are you going to buy low and sell high? Are you going to dollar cost average your purchases? Are you going to invest for the short term and then try to flip that into something more? Are you building something that will last? Are you trying to position yourself to where you have like an end goal almost, or like an end goal portfolio, like you set it and not so much forget it, but you set it and it just runs? Do you want to follow the herd, which is not me, but do you want to follow the herd and their single stock fool picks, or forge a different path, which is what we did? So our cork board strategy, right, or the stuff that's on our cork board strategy, is that we use the strategy that I'll get to, unless we have a really good reason to not use the strategy, which I'll also get to. We want to target monthly dividends, unless we find an amazing deal on a quarterly payer. We look at bonds and senior loans, especially if you can get them cheap. Uh, they have to fit the metric, right? We look at real estate, which would really take off if the Fed cuts rates. You look at energy infrastructure, so the stuff that I've already talked about, but as well as how technology integrates into that. And then we want to look at data and data management, because you can have all the AI in the world, which I think all the AI in the world honestly is a bad thing, but you still need a place to house all the data, and you still need a safeguard in how you house all the data, right? So data management and cloud tech is huge, because you have to have that as you integrate all these other things. And that Matthew McConaughey commercial on the new digital gold rush is accurate. I mean, it really is. We're in the midst of a technology rush, and your data is the new gold. So if you could find a way to land the gold mine and get it discounted and super cheap, that would be ideal. And then things that we're looking at that are not required, but they're amazing. So if you could find a fund that is structured to have convertibles where they can switch between stocks and bonds, not the top down, wind blowing in your hair, or maybe wind blowing behind you, not that. And then preferreds, where preferred dividends pay first over the common shares. So if you have a fund that is loaded with preferred shares in a stalling recession-based environment, preferred shares will still pay, where common shares might get cut or not get paid. So all of that kind of in the back of your head. And before I get into my specific system, I will share a comparison with you. So this comes out of uh, it's not a membership article, but so this comes out of the recent Contrarian Outlook email from Brett Owens, and it looks at his three picks on bonds. Let's see. It looks at his three picks on bonds, which are not named here, but he's talked about his three favorite bonds so often. Uh, so that his, let's see if I can make this bigger. So here we are. It looks like it's at 10, but it's not. It's really a little above 8% on current yield. And if the Fed dropped rates a percent, then he's poised, say his portfolio on these three alone would be poised for a 15% gain. Now, I say that in comparison uh, because what he's talking about, the three funds he likes the most, he's talked about before in non-membership emails. So what he likes are this fund, which does not meet our metric. The current discount is not double the historical discount, and the current discount is not greater than the 5-year discount. He likes, we own this one. Its sister fund is this one. Okay, but same thing. Current discount, and it's a more recent fund. So the I'm not as rigid in the application of the discount to the historical data, but even then it doesn't stack. So it's not equal to or greater than the 3-year average. And the other one, let's see, is down here. And it's currently a premium. No, we don't buy premium. So if we're going to go opposite, maybe not opposite, but if we're going to structure a bond buy based upon Brett Owens' bond bull suggestion, but not pick his recommendations because if they don't meet the metrics, then we have to find something equal or better. So what are the metrics? So this is the closed-end fund master list. And it says membership view because at some point I would love to offer a membership to this. But as it stands, you get to see all of it free in these videos. So here's the strategy. Every target, everything with a single asterisk we track for any number of reasons. Purple is recommended, green, olive I like, and blue we own. Gray doesn't fit the metric, and I'll show that when we get back over there. But the strategy is this. So a single asterisk is tracking for any number of reasons. 2 asterisks mean it's a dollar cost average based upon what we already own. But three asterisks means it's a buy alert because the existing discount is double the historical discount and it's greater than the 5-year discount. And in the closed-end fund world, for any number of reasons, funds go in and out of favor, and they sell for discount. There's some that sell for premium, which, so if we rank these not on alpha, but if we rank them by discount on the polar opposite, right, are some crazy high premiums. So if a dollar is break even, if you're going to buy something for a 40% discount, that's like getting it 40% off. So you're paying 60 cents for every dollar invested, right? The same is true on the other side. So that's $1.63 instead of a dollar for every dollar invested. So our goal is to not buy premium. Now there's tons of funds that are on discount, but knowing which to buy and targeting based on discount, like some funds are flatlined almost. Like if you look at the overall averages, the average never really changes. They're always on sale. And we want funds that, I mean, honestly, would, where that discount window would close, because if the window closes for uh, share increase or a dividend increase in the share increase, that's good for us. But for whatever reason, funds do this, right? Because that's the general price curve of the stock market, up and down. Versus some funds, regardless of price, their discount is like this. That's not helpful. So we want to optimize when we buy so we get the best deal possible. So if we rank by discount and then we rank by target, we get a much firmer, a much more close pack list. Current just means that we all, like however many shells of however many shares, there we go, of what we already own. Shares and cells is shells. All right, so they're all, yeah, targets wise, they're all significant as it relates to their own separate data. Like we're looking at this fund's discount compared to this fund, and we're not correlating it or comparing it to anything else. So we own everything in blue. What's recommended is by people we trust are in purple, and for whatever reason we track the stuff in green. The stuff in, excuse me, the stuff in gray, of which you'll see on the list, is because it doesn't meet our parameters. It's got less than a 6% yield, or it's higher than $16 a share. Orange, which is not listed, would be a fund that has closed, and I haven't seen anything else on it. So this is the list. So how do we trim it down? Well, the goal is monthly. Uh, this fund is a energy infrastructure company. Um, recent dividend raise, recent price increase, still pays a great yield, still meets the structure of this, but at the same time, it pays quarterly. And quite honest, we already own a good chunk of it, so it's not on our list. Um, Next, we rank by yield. Our goal has been 9% above, unless we have a really good reason to pick a different fund, and that would be this one. So if we go back to the master, it's got the greatest discount. It's actually come down. That's gone up. And it's an interesting portfolio. It used to be all bonds, and then they switched. And when real estate was really unpopular, they switched to real estate and senior loans, so more floating rate, more variable rate, which is great for an upcoming market. But they're dealing with the fun of switching a portfolio, to be honest. And in doing so, they cut their dividend in half. So if it's the former dividend, it's insane. But currently in this market, they cut their dividend. Um, so we would be foolish to ignore this one, but we can delete everything below it, as well as everything that's not 9% above it. And these two are going to go. I mean, it's the same portfolio, just slightly different. Yes, they pay. I mean, really, they pay about the same on yield. I'm not crazy in the consumer, which I get that you could kind of almost put everything in consumer because it's all a consumer-based product. But consumer would be more cyclical. Um, like when grills go on sale, or when mattresses go on sale, or when cars go on sale, like the cyclical nature of when all that stuff is popular and not popular. And I'm not a huge consumer thing because the consumer landscape is so fickle. Um, like the market in general, new investors and that talk show circle of fools is fickle, but the consumer sentiment sector is so fickle. Like Calamos, I love the fun. I love the name. I like how they manage stuff. I'm just not huge on consumer, or maybe outright consumer. Maybe that's a better way to put it. So that leaves us with this. This one is outright technology. Like it is built for the future technology. It's not just semiconductor chips and all that. Like it's the management system and the rest of it. The thing is, their dividend has not changed. Their price has gone up. Still pays a fantastic yield. Discount wise, it's still relatively close to the overall average off the last year. And closed-end fund investors, we are very hesitant when it comes to new funds. Uh, like the market space in general, we're just very hesitant when it comes to new funds. But I mean, God, we bought 50 shares of that, and hindsight is hindsight, but it's just never fit to pick up more. So we've just run with it. Um, but buying more of it right now for us does not make a lot of sense unless we just want to cut our profits in half. And for 50 shares, it just doesn't fit our needs right now. Technology's still in that bubble. I still think technology will hiccup at some point, and if the hiccup happens and the bubble pops and the price drops, then that's a much better time to buy that fund. Uh, this one used to be, it still is floating rate loans, but they've also built their own closed-end fund portfolio, and not all the funds are funds that I would like. So uh, I honestly think, and I haven't said this, but the rationale would be like, so they love the aggressive Fed, but the Fed's about to turn not aggressive. So they cut rate, cut rate, cut rate, and let the market open back up. That's not aggressive. So it's almost like they built this side portfolio to kind of offset the other side of things. But I get the dividend is there, but it's just it's not where we need to be long term right now. Like we're great right now, we'll hold it. When the discount opens back up, which the discount isn't bad. I mean, the discount is great, but when we bought it, the discount was higher. When the price drops a little bit, they raise the dividend, right? But just not in the current market. Um, that leaves us with pretty much where we were last week, except that new addition. RLTY is, yeah, they have the Cohen and Steers name. It's real estate, but it's not real estate how most people think about real estate. It's not single family homes or apartment complexes. It's not multifamily living. It's not condos. It's so these are the two uh, cell phone towers that lease space to all the cell phone carriers, and all the cell phone carriers route their data through there. Um, God, great, just great companies, just not how most people think of real estate. That being said, we already own a company that does similar. Uh, CBRE owns storefronts, hospital space, um, strip mall space where I live because you see their logo, or you see their branding uh, on the for lease or on the for sale signs. So they're already doing, won't say the same thing, but they're doing similar stuff. And it's the highest cost on this page. And I I don't like paying more than I need to. We've paid uh, a decent amount for shares in the past, and I honestly try not to. I will spend more money when needed, but I really try to spend less than 20 bucks. But since we've started, I really try to stay around 10, 11, $12. And $14 I get is not that big of a difference between 12. But for something that we already have, wrong one, for something that where we already have real estate that does similar stuff, it's hard to spend $14 when I could get it for cheaper. Um, so it's tempting, but it's not, it's tempting. Uh, but I don't think it'll, well, no, I already know what I want. It won't make my priority, I guess you could say this week, but it'll stay on the list. So what else is on the list? So you've got a mix of things. It's not a straight portfolio in a can, like it's not everything, consumer, finance, all the stuff, but it's this, and that's everything that's on our list. These two are sister funds. You can argue with me about why I opted to get the same fund, and it really is the same fund, just one version and a second version. And I would listen to you because you said we bought this fund first. I saw that fund, and honestly, I like this one a little bit better. Um, but we'll keep both for a little while, and I think at one point just consolidate, meaning I'm going to have to sell one and then reinvest the money into something else. Uh, this fund is all corporate bond or all corporate bonds, but all American corporate bonds. The biggest difference between these two and this is the price swings wildly with global with the global landscape, and where I don't get freaked out by international events, the average investor gets freaked out by the international events. And I think part of that is just their own comfort zone. And I also think the other part is those talk show guys push fear. They're fear mongers, and they amp up the beginner investor, which is a lot of the general market space. So when the fear and greed index is in greed, you've got a ton of new investors pumping money into the market because they're watching these talk shows and they're buying into the, oh my gosh, it's the time to buy, and ETFs are amazing, and bonds and AI are spectacular. And they're funneling their money into the stuff that's popular because that looks like the obvious thing they should be into. But that's kind of the opposite of us. What's the popular move is generally the more expensive way to go, versus the not popular is where you can score a deal when the general greed index is high. Versus if this greed index ends back up over here in the near future, when everything is low because the new investor went, crap, I put my money in the market now it looks like blah 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 is going to happen, and I'm really scared, so I pull all my money out of the market, and then the market swings back the other way, and we have these newbie investors. It's like stepping on the gas and hitting the brake, stepping on the gas and hitting the brake, and that's the crowd swinging this metric, and they're swinging the metric based upon their own inexperience, but they're also swinging it based upon the talk show, right? So when it's in greed mode and it's, oh my gosh, technology and this and that and the other, and new investors are flocking to all these things, we have to look in a different area to get a much better deal. Versus when it swings back down because they get scared, then when things are cheaper and the discounts are wider and nothing is a good buy, then we can really target the bigger fish in that small barrel. It looks like everything's on sale, right? Maybe it is. But if you play the discount game, then it'll really narrow your focus. And gosh, it really is. It's like hitting fish in a barrel. So you have the global swing of things, where you just have the U.S. economy, and you can argue for and against that. I am intrigued by a all American bond company. So then we have, right. So mixed portfolio, bonds with AI, but a global tilt, all American bond company. real estate, just a different type than how most people view things. And then a company who went from pretty much bonds into real estate and private senior loans, and they bought into their overall uh, parent company's real estate portfolio. And initially, people were like, I mean, they almost hated the lack of diversity, um, seeing as they bought internal. But recent reports in general, recent optics coming out of the contrarian outlook as well, that HFRO seems oversold, like the fears are oversold or overhyped. The fund itself is doing well. They're just kind of in that deep breath before the Fed cuts rates. So, where do we go? Don't own that. Don't own that. Own that. And that's roundabout what we currently have. But what that doesn't keep track of is our overall plans. So this pays on a 14710, true category one. It'll pay its next dividend, and our goal is to sell the fund. I'm not happy with this fund because they increased the dividend slightly following like 6 different rate cuts. It's a technology-based account. I don't know what they're doing. I mean, like they have all the big name players, like, and in a technology boom, they're not raising the dividend and their price hasn't gone up. I don't know what they're managing, but they're not managing it well. And then this one got bought out by Aberdeen, who is just not my favorite company. Um, and we bought it high. Um, so the goal is when they pay that payout, we get our additional fractional shares because it's also an automatic dividend reinvestment, meaning they take your dividend and then automatically reinvest it into the company for you, which is not helpful to me. It's not my style of investing. So when this one pays its next dividend, our goal is to let the dust settle and then sell this. When this pays its next dividend, like on 4/1, we will let the dust settle, everything clear, and then sell that. And then other things, this one, uh, I voted against it, but this one moved from closed-end fund to ETF. So currently it's still in the closed-end fund registry, but once its documentation and everything gets processed and finalized, it will shift into an ETF. And since this is a purely closed-end fund portfolio, we'll sell it. Which would honestly, it was on our radar to sell. I mean, we tried to uh, differentiate between funds based on how much we own of each. Like 200 or more, we would keep. Less than 200, we would sell at some point, or like this one, waiting till it hits that next uh, waiting till it hits the next discount metric versus this one, waiting till it gets closer to that price again. Uh, but yeah, I mean, at some point we were going to sell it. So whenever it transfers over to ETF status, then we will sell that fund. Um, and I say that because we could pick up 50 shares here. We could. Or we can let the week play out. Um, let this week play out. We'll get our March dividends for the most part, like around Thursday, maybe Friday. Um, we'll have that other dividend settle on Monday. And then early next week, we can look at buying and selling. And then this will go up and we can really see if we want to go higher. Oops, wrong ones. This. We want to go this, right? So if you look overall, or if we want to buy something different. And this is a great dollar cost average for us right now. So if we bought tomorrow, we would buy this, and which we might anyway, to be honest. We would buy that. And then once we settle on those sales and see how much we have, then yes, we will look at the metrics for the next week or the week after and buy the next round based on that. Because we want to buy for the current market, right? We also want to buy with what we think will happen 30, 40, 50 years from now. But at the same time, with the economy slowing, with more people, it used to be just the contrarian outlook and me thinking about recession early next year. But now with more people jumping on, yeah, we are going to have a recession issue. And with more people talking about that, we want to build a portfolio that will do well. So with cut rates and in recession, and then past that, you can play the buy and sell game, like the flipping of stocks game. But quite honestly, it's really hard because the market is so fickle and these new investors are so fickle. Um, it's really hard to flip stocks. But if we can build something that will pay consistent dividends and we'll deal with the hiccups, like was I anticipating a dividend cut here? No, but we've gone with it and we've adjusted to it. And I still think we're set up well. I still think we're set up well for the long run. I still think we're in a good position for the long run. Uh, it's just we can't just look at the market tomorrow. Like we can, like these are the existing stocks, these are the existing prices, this is what we have to work with. But looking at the metrics just based on price for tomorrow is not, it should not draw our attention as much as the overall discount, right? When it pays, the yield, all that, but also where we think the market will go. I think that's just as important and what a lot of people are forgetting. So where the market is now is important. Where the market will go is important. Where we think the market will end up is still just as important. And I get it. Like none of us know the future, but we all see the current needs of society, and those needs aren't really going to change. Now, in principle, like as it comes to the market, I'm not talking about anybody else, not politics, not belief system, not anything else, just where we think the market itself will go tomorrow, next week, right next year, and long term. Like we can all see, hopefully, what the market needs. We need oil. All of these things are dependent upon the overall cost of oil, right? And how that is integrated through technology and through use in society. Kiyosaki's version is buy what the Fed cannot print, but they can print money, right? So if you're not buying what they print, that's oil, that's bonds, which you can argue that's based upon what they print, but oil, bonds, and real estate. And in general, oil, bonds, real estate, but also digital real estate like data management, those are our four areas where I think we can look now, where we can look in the immediate future, where we can look in the very not so distant future. So that's what I got for this week. If you like the video, please like the content. It really does help push up or push out these videos to other people. You can also consider subscribing to my channel and then head over to Facebook and find my group there called Navigate Your Finances and learn more about our overall 12 steps to financial freedom. So whatever you have for the week, you are the captain. You are directing your course. If you have no idea where you are and you have no idea where you want to go, how do you know you're not just turning in circles? But if you knew where you were and if you knew where you wanted to go, I'm not saying the journey would be easy, but I am saying you would have a purpose, like you would have a direction to go. So if you want to know where you are, not like you're sitting in a chair, hopefully not driving in your car, but if you're not so much a physical present location, but if you want to know where you are financially and you want to know where you need to go, then go to Facebook and check out my stuff there. But that's where I say you're a captain because your life, your overall purpose is the boat, and you're the captain. That boat will go wherever you steer it. So if you're not steering it, who knows where you are? Who knows where you're going? Right? Could be going in circles, could be anywhere. But if you want to go somewhere and you want to make progress and you want to accomplish your dreams, then captain your ship with purpose. By all means, check out my group. And if not, that's fine too. Know where you are, know where your dreams exist, and it becomes your job to make your dreams happen. And you can't. You just got to do a lot of work, to be honest. I mean, it's not easy. It's fun. It's challenging. Though there are days where I don't feel like doing much of anything, but it is challenging and it is fun. So make your dreams happen, right? And I said all the time, your dreams exist. If they could have happened on their own and you had nothing to do about it, it was like, I want to do this. Proof it's there. If it could have happened on its own, it would have happened on its own, but it hasn't. Therefore, you must make them happen, which just means you have to pilot your ship. You've got to captain your ship from where you are to where you want to go. Yeah, end of story. So be the captain your boat needs, be the captain your family needs, right? Make your dreams happen. Don't wait for them to happen. Don't wait for whatever scenario, like I'll wait until I retire or I'll wait for this. No, make your dreams happen because they will not happen if you do nothing. So do something, have fun, live life. Life is not experienced at work. It's not. Life is experienced everywhere else besides work. So get out there and enjoy it and enjoy your family. Make your dreams happen. Have a great week. See y'all on another video. Bye-bye.